What is happening? This is Colin Andrews-Egbert, and today what we're going to do is show you a deal that really checked off a lot of the boxes as far as what it is that we're looking for, but ultimately we had to put this in the no-go, the red light category because of some tax issues. However, there was a lot of really benefits to it, and so we have, as you know, we have deal partners, folks that they're in there, they're checking out the deals, they're looking at all the numbers, they're talking to the sellers, they're analyzing and going through their due diligence. And then we have the deal investors like yourself who's looking to bring capital, looking to bring equity, become a minority partner, and to get a front row seat on the education part of learning that specific business. And so there's really two parts of the education. There's the education of the deal making, which is what we're doing right now, looking at what type of deals that are interesting to us, which ones are definite red lights, as we like to call it, and the actual business itself, so that once you partner with us, that you get a front row seat in the actual business, not on the deal making side per se, but the actual the inner workings of the business that you'll be an investor owner of. So today we have Bimbi Phillips. Bimbi is a part of our deal team. He's constantly looking at deals. He's on the other side of the pond in the UK, and he has a really great knack of being able to analyze these deals, check out what makes it interesting, something that we should look at, but also and sometimes even more important is why it is not a deal. So Bimbi, take it away. Please share with us the deal that you have for us today.
Great. Thanks, Colin. And it's always good to be here. So the deal I'll be taking you through now is a business that, like Colin said, ticks all the boxes. Almost passed the due diligence, and the only thing that made it fail was the tax issue, which was a bit sad, really. And this took about 6 to 8 months, right, to get to that level. So first, it's just an introduction about me and my background and the businesses that I've consulted for. Now, this particular business is something called a Smart Conservatory Installation business, right? They do with conservatory installation, repairs, maintenance, and things like that. And it's a reputable business. It's been around for at least 10 years and has very good customer reviews online. Also, very loyal customer base. Operationally, I would say they're stable. We did need to bring a new general manager in to replace the owner, but we did those interviews and we found the perfect candidate, and we did our interview along with the seller as well. Now the business, doing about 5 million in revenue. Kind of stable, so stable numbers. We like to see stable numbers. It means that there isn't any major thing changing about the business, and when we come in, there's not going to be a major distraction or a swift change, and we can just focus on growth. So 5 million in revenue, doing very strong net profit margin. As you can see here, even though declined just a little bit, but it's still very strong. Any business above 15% net margin, it's great. So for this particular deal, the seller just wanted to, he wanted to relocate and extract as much possible liquidity from the transaction as he could. And then he was really interested in our growth strategy as well in growing the business, which leads to the opportunities that we identified in the business. So we identified a lot of market expansion. We could diversify the service as well, introduce new products, especially in the energy efficient sector, and introduce more premium upgrades as well. So we saw some very strong growth opportunities for this particular business. We do very detailed analysis as well. So we did analysis of the competitors just to understand what the competitors are doing as well. Now, in terms of the known challenges for this particular business, we know that there are seasonal demand fluctuations, right? For example, in some parts of the US or even in the UK, the weather is cold at sometimes or warm and sometimes, right? So for smart conservatories, people tend to, make orders when at a particular season, right? Maybe they want to enjoy the warm weather and they want those conservatory, but if it's cold, then they don't want it. But it's just also trying to adapt product for specific seasons. And there are other challenges as well that we do monitor for the transaction. And this is how we execute the growth, right? So we saw the opportunities earlier. We come up with a detailed business plan. Now, this is just a high level of what we're going to do, but we do have detailed business plans on the numbers so that when we are confidently telling our investors that we are going to, double your, 2x the business or 3x or 5x the business, we have a detailed plan that would support that. So we're not just making up the numbers. We know exactly what we're going to do and how we're going to go to market with that. Now, this particular deal structure, it's in the UK, so it's in pounds, but it's exactly the same thing we do for deals in the US as well. So the total valuation for this deal was 6 point something million, 6.3. We valued it at 3x or 3.1x with the growth plan to immediately move that to 5x. And we had a detailed plan on how we're going to do that. We're going to acquire 95% of the business and the seller retains 5%. So we needed an upfront payment of 1.6 million at closing. So in this case, if, for example, if this was a US deal, we then would go to the SBA to raise the 1.6, but then we need investors in Colin, in your network to put in a percentage of that, right? That's how it works, isn't it? Yeah. And then the remaining 4.4 at seller as a seller note or earn out, meaning that it's going to be paid by the business over a period of 5 years. The business had a cash in bank of 3.7 million. So meaning that including the 1.6 that we're going to give the owner, he's also going to walk away with that cash. However, we're going to subtract working capital from that. So it's going to leave some money in the business so that the business can operate at least for a period of 3 months of the first quarter after acquisition. To sweeten the deal as well, we give him an earnout of 40% on free cash flow above 1.8 million. What that means is, if the business continues to rise, right, especially the way it is, I think the cash flow it was doing was about 1.6. But if the business, everything continues to go really well and we achieve at least 1.8 million, anything above 1.8 million, we would give him 40% of that over the period of 5 years. Now, some people might think that, wow, that's a lot, 40% above 1.8. So meaning that if the business makes 2 million free cash flow, he's going to get 40% of 200,000. We don't think that's a lot because most times the things that kill deals post-acquisition is the non-involvement of the seller. So we need to see how to keep them locked in, not just locked in, but for them to be fans of the business growing for 5 years. Right, so we're hoping that at the end of 5 years, even 2 years, but in this case, at the end of 5 years, we are really fully in control of the business. Even our investors have made their money back. Everyone is happy, right? So we earnouts are a great way to lock the seller in. It's not contractual that if they don't earn it, something's going to happen. It's basically, or if we don't hit the 1.8, they have to get their 40%. No, it's contractual in the sense that it's a form of thank you to them for getting involved and helping us push our plan through, rather than picking the phone and trying to chase the seller because we need their help post acquisition. As part of the deal as well, he has a personal loan of 1.5 million from the business, and we're going to write that off as part of the acquisition. So you would see that the total acquisition cost is going to be around 11 million, which is the purchase price, right? Because you have 6 million valuation, 95% of that 6.3 million is about 6 million, and then 6 million plus the 3.7 cash in bank is about 9.7 million. 9.7 million plus the 1.5 million loan write-off is about 12.2 million or 11.2 million or thereabouts. So that's the total cost of the purchase price, 11.2 million, and then we give him 1.6 million upfront cash. Any question by this from you, Colin, on this? Because this
no, that's pretty clear.
This is the deal structure we usually go through.
Yeah, and I think just for anyone that's listening to this, that again, we're going to be focusing on deals that are in the U.S. That qualify for SBA financing. So this deal wouldn't not qualify for that. However, I thought that this was a very interesting deal structure, and just the overall. The potential and the opportunities of the deal. So that's why we decided that we wanted to share it.
And it's exactly the same process. The only difference is changing the pounds value to dollars, right? So it's exactly the same process from start to finish. And then other things, we usually negotiate a working capital because we want to ensure that the business can run for at least 1 quarter or 2 months at least, without any additional capital intervention in. For this deal, every deal we have a deal team. The GM of the business is also involved, and these are the staff that they have. And we also, most times we have advisors as well who, we like to put as partners in the deal as well, just to make sure that everything about the deal is secured, and we've crossed every T's and dotted every I's.
Got it. No, that's great. Great overview on it.
Great.
Excellent. So for anyone that's listening to this, again, what our whole strategy is to take the deal investors like yourself, folks that they want to get the front row seat, you want to learn the business, but you're not ready to take it on yourself. You're not ready to sign your name on the loan. And we connect you with the deal partners, individuals like Bimbi, who are constantly, in the heart of it, looking at deals, analyzing it, figuring out, what are the pros, the cons, does it make sense to continue to move it on? And frankly, like when we see an interesting deal, it's all about like we're trying to almost disqualify it, right? Like that's really the goal, is to figure out, okay, why doesn't this pass the muster? Why doesn't this make sense to continue on? Because at the end of the day, the last thing we want to do is to do a bad deal. One of the benefits of having SBA is that they're also going to be looking at it, and all the deal partners, all of us, there's always the SBA, like even when, I was focused on self-storage, SBA was, everyone complained about it, that they look at everything and they analyze it, and that there's such a pain to deal with sometimes. But that's what you want as a investor partner. You want somebody that goes through it, that really, through with a fine tooth comb, figures out, do they want to loan the money? Because at the end of the day, they're the ones that are offering the 90%. They're offering around a 9-10% rate. So if they're going to be offering the majority of the purchase price of the amount to buy the business, and they're getting a lesser percent, they're getting around 10%, let's say, they really have to make sure that the numbers work, and that 3% or less default rate doesn't go any higher than that. Any thoughts on that, Bimbi?
Yeah, sure. You're spot on and exactly right. So, but I think one of the benefit that we get is because we are very detailed with analysis and everything. The process with the banks, SBA, it's more, it's quicker, because if we don't do a good job, then their process will just take more time, right? Mm-hmm. But yeah, it's required. At the end of the day, nobody wants to do a bad deal.
That's it. Awesome. Well, Bimbi, thank you very much for sharing what you did, and let's keep on looking at some deals and find some winners out there.
Great. Thanks, Colin.